Thank you. Good afternoon, everybody. On behalf of the University of Chicago and the Northeast Ohio Alumni Club, I'd like to welcome you to the Economic Outlook Roundtable discussion for 2012 and beyond. I'd also like to thank the City Club for hosting this event today. My name is Mike Coxon, and I am a graduate of the University of Chicago's Graduate School of Business, now known as the Booth School. And I'm a senior expert at McKinsey & Company. I live and work here in Cleveland. I'd also have with me three distinguished economists who are going to walk us through their perspectives today. And before I introduce each of them in turn, what I wanted to do was just spend a moment or two laying out the format for today's agenda. First, we'll have each of the economists provide an overview of their current positions and perspectives. We'll then move to a dialogue discussion where I will ask a couple of questions based on some of the themes that emerged from the first part of the agenda. Finally, we'll move to a Q&A session where you in the audience obviously can participate and ask all the questions that you'd like. Okay. With that, I'd like to move on to the first session. And to do that, I'm going to begin introducing our first panelist, Professor Robert Aliber. Professor Aliber is a professor emeritus at the University of Chicago. He's a professor of international economics and finance. He's also published quite widely, and you'll see his book, Manics, Panics, and Crashes, is available when you walk in the lobby. It was recently named one of the best investment books of all time by the Financial Times. Professor Aliber also consults to the World Bank and has testified before Congress. Welcome, Professor Aliber.
Thank you. Thank you. Thank you. It's a pleasure to be back in Cleveland. I was here 2 years ago, almost precisely 2 years ago. And one of the things that I took away from that meeting was that the U.S. economy was beginning to recover, was recovering from the recession, and we are now in the third year of that expansion. I want to make three comments today. The first concerns why this recession is different from every other recession since World War II, and that leads to the question, is it appropriate to use the term recession to describe the experience since 2007, 2008? The second is I want to talk about the housing market and the contribution of sluggish housing to the high level of unemployment. And then I want to talk about the trade deficit or the large trade imbalance with China and the contribution of that large trade imbalance toward the very high unemployment rate that we continue to have. So let's go to the first issue. This has been no ordinary recession. The financial system came close to a collapse. There has been no recession between 1949 and 2001 in which the stability of the financial system was in doubt. We came close to a major financial disaster in the second week of September 2008 when there was dithering in Washington about whether to save AIG. If we had saved Lehman, if the U.S. government had intervened on the Friday before the Monday when Lehman collapsed, the history of the last 3 years would have been very, very different. And the high level of unemployment would be much lower than it has been. Washington was caught up in a set of cliches, and the Fed, forgive me, and the Treasury had not done their homework. What are we going to do if a low probability event happens and the financial system is jeopardized? So we've lost a large number of major investment banks, etc. So that's the first issue. The second is that we normally, in the 1980s and the 1990s, produced 1.5 million units of housing a year. 1.1 million was required to accommodate the growth in the U.S. population, and the other 400,000 accommodated the increase in demand for second homes and the loss of homes due to attrition, old age, firestorms, and highway widenings. We've been producing, in the last 3 years, between 500,000 and 600,000 homes a year as we work off the excess supply that was built up between 2002 and 2006 and we deal with the very ugly foreclosure problems. If we were producing, if we were producing 1.5 million units rather than 600,000 units a year, our unemployment rate would be nearly 2 percentage points lower, and the growth rate would be nearly 2 percentage points higher. In the previous recoveries, housing investment led the recovery. This time around, housing has been an anchor, a drag, a caboose with brakes on the recovery. The last issue I want to talk about is trade. The U.S. trade deficit has increased by nearly $300 billion a year since 2007-2008. So we then had a trade deficit of 200 billion. We're now up just south of 500 billion. Let me take you through the arithmetic. It's very important arithmetic in a city like Cleveland. Value added per worker in manufacturing averages about $80,000. So let's imagine that our exports went up by $1 million, or our imports went down by $1 million. So there was $1 million more expenditure on domestic goods rather than on foreign goods. That would mean 12.5 additional jobs in the United States. That's for $1 million. So let's change the metric from $1 million to $1 billion. Now we have 12,500 additional jobs due to an increase in our exports or reduction in our imports. And if we increase the metric from 1 billion to 100 billion, now we're talking about 1,250,000 jobs in manufacturing alone. Our trade deficit with China is half of our total trade deficit. So if by some magic the trade deficit with China were to disappear, there would be 3 million plus more jobs in U.S. manufacturing, and a lot of them would be in Northeast Ohio. And that's just the arithmetic. What has been happening, there's a great deal of chatter out there that the United States is not competitive. We are not competitive because foreign countries, China especially, maintains very high tariffs. Every state-owned enterprise in China has a buy China policy, and they have kept the value of the currency exceptionally low. So let's come back to my arithmetic. If we spent 100 billion more on U.S. goods rather than on foreign goods, we would create 1 million plus more jobs in U.S. manufacturing. Those people who were newly employed in manufacturing would spend 80% of their incomes on U.S. produced services. We can carry out the arithmetic, but the principal reason that despite this expansion we have a very high level of unemployment is that the trade deficit has increased quite substantially. The central issue that we should be thinking about as we go through the political campaign in the year 2012 is which presidential candidate has a credible program for reducing the trade imbalance in a sustainable way. One last comment on this issue. I've written about this extensively, and one of my former students said, "Bob, you're going to start a trade war." And I said, "Oh no, you've missed it. The trade war has been going on for 20 years, and our friends in Asia have been practicing guerrilla warfare against us, and it's time for us to respond appropriately and peacefully." Thank you very much.
Thank you, Professor Aliber. I'm going to introduce our next panelist. It's Dr. Mark Schweitzer. Dr. Schweitzer is a Senior Vice President and a Director of Research at the Federal Reserve Bank in Cleveland. In his duties, he sets the department's research agenda. He also briefs the bank's president on activities and in advance of the Federal Open Market Committee meetings. His own research is focused on labor market developments and the factors contributing to regional economic growth. He joined the bank in 1992, spent a few years in England at the Bank of England and has come back to Cleveland. He's originally from Seattle, so the one thing I note, Dr. Schweitzer, is it seems as if you really enjoy rainy climates. And I'm sorry that today is a little bit sunnier and warmer than you're probably used to, but you'll have to put up with that. Welcome, Dr. Schweitzer.
Thank you. Well, I'm going to have a little more pedestrian take on the sort of state of the economy. I want to talk to you a little bit about how we're seeing things develop, and with a discussion about why monetary policy is what it is today. So in that, I want to think about three parts of our outlook in broad terms. I'm going to start with output and discuss sort of why we see output growing and, sort of approximately how much. I want to talk a little bit about labor markets because, we all care about being employed, and, if it's not you, you're concerned about a daughter or son. And we want to see employment growth in the U.S. because there are real issues there. And then finally, I do want to talk a little bit about our inflation outlook because that is critical to forming policy. So let's go back to GDP growth. We are in the third year of recovery. One of the people who I've listened to on these matters points out that, as recoveries go, there are about 3 decent quarters in this recovery so far. This has been a very mild recovery, and there are various explanations, and Professor Aliber has offered some of those explanations for why this has been a lackluster recovery. Nonetheless, I think we are seeing some, momentum, some improvement in the economy. We're seeing and expecting, and I think in this, when I say we, I want to cite the FOMC's own forecasts. So the committee members turn in their forecasts. We're one of the banks that does that. I am not supposed to reveal my particular individual submission into that process, but as a bank, we're part of that process, and we are generally agreeing with the outlook. So the committee members are expecting growth to be sort of a bit below 3% this year, and then moving up to 3% going forward. Now that is a decent sounding number. Says, well, we're making some progress in our economy. It doesn't sound outlandish. It also does not sound like the really good years that have followed some recessions. So if we look back in history, and you go back far enough, you can definitely get those 5% years, and 4 would be a decent number. And in fact, if I look back to what the committee was forecasting last year at this time, there were a decent number of committee members who were forecasting a GDP growth over 4% in the coming recovery. Everybody sort of pulled back a little bit. But I think the outlook is actually getting a little more solid in our commitment to it. And where would I look for sources of growth? I continue to see investment spending of firms continuing and improving. That's something we hear repeatedly when we talk to businesses, and it's certainly supported by the models. I'm not expecting housing to be a recovery. On the other hand, it's been sort of bumping along the bottom for a while now. If I look at the near-term data, we have seen a little bit of an upside, but I'm not expecting that to be a driver. What I am thinking is, getting to be a little more comfortable are households. So households, clearly were a major component in this downturn, with households pulling back in the face of a very much more challenging financial situation. That persisted really quite a long time. Well, during that persistent phase, the debt service levels of households went from being record high, so as high as we'd ever seen, sort of the share of households' income that was going to paying off their debt, down to we're back into the 1990s. And in fact, we're even similar to some 1980s levels of debt service for U.S. households. That gives me a much more comfortable view on sort of how can household spending progress and grow in a normal way. So let's take a quick look at unemployment. So unemployment is going to be a continuing issue. We had an exceptionally high unemployment rate. I'm not going to go into sort of the sources of that. We have been seeing gradual progress on that. There's a little bit of discussion in the Wall Street Journal, New York Times levels recently about how is this squaring up with the GDP growth and the relatively low GDP growth we've seen. But overall, I think, if I look over the expansion, we've been seeing a fairly conventional recovery in employment. And we are expecting that to continue. And then finally on inflation, I do work at the Federal Reserve, and we have a dual mandate. We are focused on inflation. We're focused on getting the economy back to full employment over time. That inflation number is one where I think going back 2 years ago, there would have been a lot of people who would have said, hey, we think inflation's going out of control. You've produced way too much money. There are too many reserves in the banking system. Inflation's going to be really problematic. You look back at the history, the inflation rate of the last 3 years is roughly 1.5%. Sure, inflation's a hard to predict thing. It's a volatile thing. It did go over that. It did come under that. We've seen a lot of regular variation in that, but in this environment, we are not expecting inflation to accelerate. We're expecting it to stay, in the 2% on the PCE basis or 2.5% on CPI. And I think there's a lot of good grounds for that. Some people would say you don't want to be sort of overutilizing any sort of Phillips curve. I'm fine with that. On the other hand, let's look at compensation. And we're all probably pretty aware of how much compensation growth there is in our economy. Fundamentally, not very much. So when you're thinking about antecedents to how much is a service worker, how much is the work that a service worker going to be charged to the client, that's going to be heavily compensation focused. And it's one of the reasons why we're seeing inflation continue to be low. So tying all of that together, I think this is sort of suitable grounds for an accommodative policy. As my bank president said here about a week ago, I think there are good reasons to not sort of add additional accommodation. I think there are good reasons to be where we are today. So I'm happy to stick with that view.
Great. Thanks, Dr. Schweitzer. I'd like to introduce our last panelist now, Professor Charles Upton, Professor Emeritus of Economics at Kent State University, formerly the Dean of the College of Business at Kent State University, also a member of the faculty at University of Chicago and Rutgers University previously. He's the co-author of 3 books and has been published quite extensively in different economic and political journals, including the Journal of Political Economy and the Journal of Finance. Professor Upton?
Thank you. The next time I do this, I'm going to negotiate the order of speakers so I don't go last. Look, this has been, there's the old Chinese curse, may you live in interesting times. We are living in very interesting times. We've had the sharpest decline in the economy since World War II, followed by, I wouldn't use the word weak, I'd use the word an anemic recovery. We can debate about why we've had both of these. I think Bob is correct that we had a classic financial panic in 2008, and that caused a decline. But where do we go from here? The data from the last quarter have been very good, and I think a lot of people now think we seem to have turned the corner and things are going to begin to get better. But that's not a forecast. I also learned when I was a young economist what I call the iron law of forecasting. If you give a date, don't give a number, and if you give a number, don't give a date. I'm going to try to avoid doing either. My guess, and I think, and I hope that we are about to enter a period of more or less normal growth, not the kind of anemic stuff that we've had in the past couple of years, but more respectable growth rates. My concern is that I see some warning signs that make me fear, not forecast, but fear that we may be entering a very prolonged period of low economic growth. And see, you leave me last, I bring all the bad news out. And let me just mention some of these things that I'm worried about. First of all, I very much worry about the housing market. It's in disarray. There's a significant number of houses that have negative equity. I've seen different numbers. I saw one number that was 29%. I think that's a little high. But I just know that for the next year or so, we're either going to see significant numbers of foreclosures or significant numbers of mortgage write-downs. And until this process comes to an end, I'm dubious about significant recovery in the housing market. I also worry very much about the euro. I mean, this is not our problem, but Europe is a major trading partner, and disarray in the euro can really spill over and impact the United States. I know Greece has just reached an agreement, but I went to a talk in January by Catherine Reinhardt, who pointed out that in the 200 years since Greece got its independence, 48% of the time, Greece has either been in default or on the verge of default. So I don't think, I'm not sure we're done there yet. And I also worry about the Federal Reserve System. In 2008, maybe a little bit late perhaps, but the Federal Reserve System stepped up to the plate and made a massive injection of money into the economy and really did the right thing. But in the process of doing this, they basically trebled something that's called the monetary base. And that has not produced any real inflationary problems yet, despite some of our mutual friends who are convinced it's right around the corner. But at some point, we're going to have to deal with that. And that means we either are going to have some relatively high inflation, or, in my opinion, we're going to have an adjustment to a period of significantly high interest rates, and either of which is going to be difficult for the economy. And there are also some longer-term issues that worry me, too. And let me just mention two. First of all, at the same time that we've had these high unemployment rates, we've had a number of occupations that are in very short supply. There seems to be a mismatch between the skills of the labor force and the skills that the market is demanding. And that's a problem we're just going to have to deal with in terms of making sure our educational system is up to the task of producing the kind of workers that the economy is looking for. And the second thing, of course, and I know people talk about this a lot, and I'm going to mention it, and people worry quite a bit about the size of the current budget deficit. I don't worry very much about the size of the current budget deficit. We can tolerate a reasonable degree of deficit spending. And to me, that means $500 to $700 billion a year. That's not a big deal. And the forecasts are that in the next couple of years, the size of the deficit is going to narrow. But if you begin to look at the long-term projections, they're really very frightening. Current tax rates are just not consistent with the kind of projections that we see in expenditures on Social Security, Medicare, Medicaid, etc. Ultimately, we're going to have to step up to the plate and deal with those problems. And if we don't, it's going to bite us. So it's again, these are things that cause me to have fear. I'm not doing a forecast. The only thing I'm going to confidently predict is that in about 9 months, it's going to be 2013, and I can begin waffling on the 2013 forecast. But now let me just mention my fears.
I'm going to hold you to that, Professor.
Okay. I'm ready to go.
Well, thank you for each of those comments. That was very good and very helpful and informative. Actually, I want to move to the second part now of our discussion. We're going to ask a couple of questions. I'm going to ask a few questions that tie together maybe some of the things that you've talked about, some of the issues that are top of mind if you read the Wall Street Journal or various publications. Maybe the first would be employment. And I would just like to ask you about the unemployment rate. That's a number that's been thrown out quite a bit. It's very top of mind right now with the elections coming up. How well do you think the current rate of unemployment from the official statistics reflects the current true health of the employment picture?
Well, I'm happy to take that. My area of specialty is labor economics, and one of the things that I've looked at over many years is how much does that sort of marginal extra workforce really matter? And in general terms, today's unemployment rate is associated with a larger unemployment rate of people who would like to have a better job than they currently have. That always moves up and down, and those numbers are, roughly consistent. We have a bit of extra slack in our economy in the sense of people who would really like to be in a different position than they would normally, but it's really not exceptional given the sort of very high unemployment rate that we have today.
I might add one note on that, and that is one exceptional feature is that we have a structural unemployment. There are 3 or 4 million people, a large number of people who have the wrong set of labor skills or live in the wrong neighborhoods, and this is exceptional. So it's either because of technological change or because of the trade issues that I mentioned earlier, but they're either going to be permanently unemployed, they're going to have to take tremendous reductions in their performance relative to their expectations, or they will retire prematurely.
Professor Upton?
There's also been a number of people who've left the labor force. I've seen numbers that may be as high as 5 million people who just became discouraged workers. And in fact, a lot of the recent improvement we've seen in the labor force has been due not to people finding jobs, but to people just giving up. And one of the things I think that's going to happen in the next year or two if this recovery continues is these people are going to re-enter the labor force, and that's going to mean that new employment goes not to reducing the number of unemployed, but to employment for people who are currently not in the labor force.
Well, on that note, I will end up being a little more optimistic. So we did do some analysis of the sort of how to think about people who have left the labor force. And if you look at past recessionary periods, the idea that, these people are going to enter, it's going to boost our unemployment rate, seems very logical, works out from the arithmetic. If you go look at what actually happens in recoveries, you only get the people entering when growth is stronger. When growth is stronger, you have better employment gains. So the stronger growth and re-entering labor force are really correlated. You don't end up getting the unemployment rate being higher because it only happens when the economy is faring better. So we've looked at those things a little bit. I think there's a lot of concern, and I agree that there are a lot of people in our economy who are unlikely to fare well unless things change, considerably, and they have skills that are not matching up well. But I do want to say that if you think about structural unemployment, you do not want to say that today's unemployment rate is largely structural. There are most of the activity, most of the people who are out of the workforce right now tend to be on the younger side of this cohort. There are elevated unemployment rates for college graduates. There are elevated unemployment rates for people with good skills. This still has many, many cyclical components to it. So I think it's wrong to jump to the conclusion, and I know no one actually did here, but I do hear it in the debate sometimes, that most of our unemployment is structural, and that I just do not agree with that perspective.
I'd like to stay on this theme of structural versus cyclical. We've talked about employment. From your perspectives, what are some other issues that may be more structural and longer term in nature, not necessarily just in the current time period, that you think are of concern going forward?
Well, actually, I'd like to say something more on the structural versus cyclical, which is not exactly your question, but I think if you think about whether, there are people who have not very good skills. And there are jobs out there that look like they are ready and able to be filled. That parallel, that was true in our economy 4 or 5 years ago. It was true 10 years ago. We've had that situation before. What's actually really interesting about today's environment is not the sort of fact that we still have some skill mismatch issues. It's that the number of openings or the number of unemployed workers for the number of openings is extraordinarily high. You go back to the 1980 recession, we reached a peak where there were 2 unemployed workers per opening. You look at today's environment, we're down to just 4 unemployed people for each opening. We've had an extraordinarily large increase in the number of unemployed without any sort of, our openings are actually still really not very numerous. So that's one of the key things that I think, people who, feel like there's a structural issue primarily, you want to keep in mind that we always have a bit of mismatch. We've always got hard-to-fill occupations, and we've always got hard-to-employ individuals. Those two situations are not new. What is new is just the absolute numbers of unemployed people.
Perhaps I could add a footnote that ties together a remark of Charles and Marx. We have a massive fiscal deficit, 800 billion, 900 billion. That's money that the federal government is spending. How can we reconcile the large excess of spending by the federal government with a high level of unemployment? And the answer is that spending indirectly is creating jobs in China and South Korea and Malaysia and Thailand rather than in the United States. And that's because these countries choose to sell much more to us than they wish to buy from us. So there's this tremendous leakage in the system. The demand creates jobs, it's just that those jobs are not in the 50 U.S. states.
Okay. Well, what about the current situation and maybe some good news? I mean, I think we've all seen in the last few months, not that there hasn't been some good news peppered throughout your comments, but there's certainly in the last few months, I think that the economy has come in a little bit stronger than people might have thought come last August through December. And so what I'm wondering is, in your opinions, are there certain things that are going to provide some positive surprises going forward over the next 9 to 12 months through the end of this year?
There's lots of good news out there, just lots of good news. Autos are doing well. Housing is picking up. Newspaper stories from Miami about the very sharp decline in the number of unoccupied, unsold apartments. So what we're beginning to get blips in the housing market, and we will see housing picking up 100,000, 200,000 units a year. The population continues to grow. People need places to live, and they can only put up living with their parents. So maybe it's the other way around. The parents can only put up having the children underfoot for so long. There's much more confidence among American consumers. And business firms are beginning to increase employment. We've had 3 great months of news. Indeed, if we weren't concerned with the high level of unemployment, we probably would not be having a panel today, because the trend of the economy is really very positive, but the trend is very low relative to capacity, and that big difference is accounted for by that $500 billion of spending that's creating jobs in other countries. I would add just one other point, and this gets back to Charles' comment earlier on the fiscal deficit. I worry much more about the fiscal deficit than he does, but we won't be able to solve the fiscal deficit problem until we solve the trade deficit problem. If we solve the trade deficit problem, that makes a significant contribution to resolving the fiscal deficit problem, because the tax base is growing much more rapidly and the fiscal revenues will be growing more rapidly, and federal expenditures will increase less rapidly. We will still need to change the relationship between taxes and expenditures, but that's a much more modest change. We really need to get the trade deficit down to resolve the fiscal deficit issue.
Well, on the little more happier note, I mean, I would point, importantly to employment. So when I'm thinking about my output projections, and I don't have the luxury of Charles of not turning in dates or numbers, they're kind of expected. And we have to put down particular numbers, and I've got someone at the board who checks to make sure my numbers are all perfectly consistent with each other. So when we think about those things, I think a really good sign is that where we're seeing growth right now being a little lower than you might expect given the employment gains, employment's a pretty reliable indicator. We're seeing pretty broad-based growth in employment across a bunch of different sectors. Here in Northeast Ohio, auto is particularly important, but generally we're seeing employment growth across and through the U.S. economy. That's producing better income growth. That produces a better household dynamic. Households are really already in a better position to be consumers. So I see the economy as brighter and more resilient because the household part of our structure looks a little better off today.
Yeah. But I think that's a key point. Things are getting better. Mm-hmm. There's a group at the National Bureau of Economic Research that's charged with determining when recessions begin and when they end. And every time they issue a press release announcing the end of a recession, Jay Leno comes on that evening and makes a joke. It's over? Delighted to know it's over now, and nobody recognizes it. And the fact is, things are getting better. They may not be getting better as rapid as they have in the past, and they certainly are not, or as rapid as we would like them to get better, but they are getting better.
Great. Well, thank you. I think it's time, looking at the clock, would love to actually move into the third part of our agenda now, and that would be the chance for you in the audience to ask some questions to the panelists. And so we've got a representative from the City Club with a mic.
My question pertains to the unspoken topic so far, oil. And maybe it doesn't belong on this agenda, but I'd like at least the nods or shakes of your head with respect to know it's relevant or irrelevant or important or almost on the agenda. Thank you.
Mm-hmm. Professor Upton?
Yeah, I showed my list of ills to a couple of people, and they all said, it's a great list, but let me add one or two. And I said, we got to get out of here today. And I thought about putting energy prices on the list. But I think the truth is, energy prices are going to go up. There's only a finite supply of petroleum in the world, and we have a number of new countries, Brazil, Russia, India, China, which are, over the long term, doing quite nicely, and their demand for petroleum is going to go up. And I just think it's a fact that energy prices are going to go up, and we're just going to have to learn to live with higher energy prices. If you ask me, are we going to get $5 a gallon gasoline? Yes. But that's a number, so you're not getting a date. I don't know when that will occur. Probably not this year, but at some point in the future, prices are going to go up.
I'm on the flip side of that issue. There are two aspects of the energy issue. One is the short-term political uncertainty concerning the Persian Gulf, whether the Israelis will take an initiative toward the Iranians, whether the Iranians will respond, etc. And the other is technological change. I am an anti-Malthusian. In the long run, the price of energy has fallen, and the more sharply it has increased in the short run, the more rapid the technological change. We're getting tremendous amount of energy at recent prices from wells that we've thought were depleted. We're in the midst of a revolution with respect to getting energy from natural gas. The price discrepancy between a BTU from natural gas and a BTU from petroleum has never been larger. It's 5 or 6 to 1. And so we're about to shift in terms of the sources of energy, much more from natural gas. We're becoming much more efficient in terms of the auto fleet, the home fleet, and the like. And I'm going to make a bet with Charles, a large amount of money on that, on the date of that $5 a barrel price.
Bob, I left my wallet at home. I can't handle it.
Well, that spans the set, but the one thing I would comment on, because I think there's a lot of concern about inflation, and we have been seeing, gasoline prices pushing up the CPI in the past couple months. An interesting thing that a lot of people haven't noticed about this is gasoline it's a bit over 5% of household budgets. An equal, almost as large of a thing is the energy consumption of households from utilities, and that's natural gas and electricity. Natural gas and electricity have been on the negative side. We've been seeing falling prices in those commodities. So that's actually been offsetting some of the increase that we have seen in gasoline. So in the near term, I think it's a mixed picture, and I always try to stay out of forecasting oil prices.
On the good news side for this region, I think that none of you specifically mentioned was manufacturing. I heard some people mention autos, but my observation is, and I used to work in economic development, was that manufacturing began to recover in this region in 2009 and has been going pretty strong. I'd like you to comment on that, but I'd specifically like to know what you think needs to happen both policy-wise and by manufacturers to make things better, other than solving trade deficit, which obviously would have a big effect, and currency exchange issues is a big issue to manufacturers. But are there other things you think should happen to strengthen manufacturing in this region of the U.S.?
Let me take the first go at that. Assume you've come up with a brilliant new technological insight and the cost of manufacturing output throughout Northeast Ohio declines very, very sharply. Your projection would be U.S. exports of manufactured goods will increase and U.S. imports of comparable goods will decline. Will that happen? That depends on the trade policies of our neighbors, trading partners. And if they decide, if China decides that it wants to maintain the trade surplus, it will respond with a currency policy or a trade policy that will negate your brilliant discovery. I was in China a couple of months ago, picked up by a former student in a beautiful Audi. And I said, where was it made? He said, around Shanghai. And I said, how much did it cost? And he told me in terms of RMB. And I said, assume you went to Germany and bought it. How much would it have cost there? And he said 20% less. China is the world's largest producer of automobiles now, and it is a closed market, effectively closed market with respect to the imports of automobiles.
I was wondering if you could clarify something for me that's in the current discourse. The issue that who creates jobs. You know, you hear that big business does not create jobs, that government does not create jobs, that only small business creates jobs. And frankly, as a layman, I get confused by this because, and how does that relate to the auto industry bailout? I mean, if the government had not interceded, would there be less jobs or more jobs?
I will share a secret with you. It's my children who create jobs in their spending patterns. It's you and I who create jobs when we decide to spend money rather than save money. And the small business, large business aren't creating jobs. They are responding to the demands from American households, and American household consumption spending is 70% of the total spending. They're on the responsive side, not on the initiative side.
Well, let me answer that question a slightly different way. So if I look at the data on employment growth, first of all, I think some of that small businesses are the only place where you see net job additions. It turns out to not be true. That we have actually been seeing decent net job growth in larger firms, for example, over the last couple of years. And of course, state governments can and do expand at different times too. So I think just fundamentally that's not the right picture. But at a deeper level, there are large businesses that are growing. There are large businesses that are shrinking. There are small businesses that are growing. There are small businesses that are shrinking. To say anything about the size being the determinant for sort of where employment growth goes seems really misguided. What is true is, you know, businesses that are expanding, which is they've got better demand, they've got more interest in their products, see growth and hire more individuals. That's the real fundamental. It's not about the size of the firm.
Yeah. I would agree. I think, you know, that small business versus large business is a canard. It's when people won't feel confident enough to spend money. It's when our children feel affluent enough and comfortable enough about their future, then the jobs get created. Whether it is a small firm or a large firm that meets their demand, that depends on the product.
What about the auto bailout question?
I'll be happy to respond to the auto bailout question, but let me speak more broadly to what I would call TARP, and the investment in AIG. When the financial markets fell apart, the U.S. government became a very profitable vulture investor. Financial markets essentially had lost all their confidence. And so I applaud the decision of the Secretary of the Treasury, Paulson, and Chairman Bernanke to save AIG. The government is going to make a profit on AIG, even though it has compelled AIG to sell some of its crown jewels at distressed prices. The government's going to make a profit on the bailout, if you want, of the auto industry. Probably, certainly with General Motors, Chrysler may be a little dicey. And at a time when the economy was imploding, this was a brilliant decision, and it should be applauded.
Well,
Professor Upton?
yeah, I would certainly be very comfortable with the bailout of AIG and most of the resources related to saving the banking system. I know that's been very controversial, but we just didn't really have a choice. The question where I'm not sure about is whether the bailout of General Motors was appropriate or not. In the following sense, if the government had not stepped up to the plate, would General Motors have been able to achieve essentially the same results by going through normal bankruptcy procedures? And that I just don't know.
But the answer is no.
Well, you're more confident than I am.
There's been a lot of discussion that the Chinese currency is undervalued. How much is it undervalued by? What are the factors that are going to influence that situation? And what do you think is most likely in the coming 2 to 5 years?
Let me respond to that. I think U.S. policy toward China has been misguided, and that Washington, the administration, Senators Schumer and Graham have confused a target and an instrument. Our target should be to get an orderly reduction in the trade imbalance between the United States and China. Let the Chinese government decide on the instruments. The Chinese government has a lot of instruments. It can change the value of the currency. It can reduce its tariffs. It can increase its foreign aid to needy parts of the world, and it can change the policies of the foreign procurement by the state-owned enterprise in China. That's a Chinese decision. And so let's focus on what is it we're trying to achieve. It's a reduction in the trade imbalance. The currency is just one of the instruments. If China continues to maintain 40 and 50 and 60% tariffs across a wide range of consumer goods, goods in which we are low-cost producers, then appreciation of the currency by 30% will be meaningless. The Buicks produced north of here around Detroit are much more competitive than the Buicks produced around Shanghai, even at this exchange rate. And of course, the price advantage would be greater if the Chinese currency had a higher value. But they won't import them because of this very high protection.
Yes. One of the questions I had, I've heard you speak about the need for housing. I also heard the comment about compensation for workers not growing, and also the need for people to actually be purchasers in the marketplace. What happens when we have a generation that's coming along now where they have declining incomes and their cost to participate in the economy now is far more expensive than it was for their parents, more or less?
We don't know. I mean, look, the old rule was real incomes double every 40 years. My generation, on average, has done a lot better than my parents' generation, which in turn did a lot better than the grandparents' generation. We seem to be running into a period where real incomes do not seem to be growing very much. And it's just a difficult transition. And people are going to have to say, well, we're not growing as much. How that works out, I don't know, and I don't think we really know. I have a sneaky suspicion that if we will schedule a panel like this 5 years in the future, we'll say, what were we so worried about? That there will be significant economic growth, and we will think that these concerns were misplaced. But that's a suspicion. Because, see, I gave a date, and I'm very careful about giving a number with it.
Very consistent,
Yeah.
Professor.
I want to go back to Mark's earlier observation about the mismatch between demand in the labor market and supply in the labor market. You ask a very sort of critical question. The demand is out there, but the people you are concerned about somehow can't satisfy the demand. And so we need to figure out investment strategies that will enable massive numbers of Americans, people leaving high school, people leaving university, and people who lost their job skills. We need to figure out some ways to enable these people to get re-involved in the labor force. And my favorite scheme is actually to reduce unemployment compensation payments and to give payments to firms to hire people for training programs of 13 weeks, 26 weeks, wage supplements until they build up their labor skills and would be hired on their own and earn a decent wage, a week's wages that they would feel comfortable with. But that's not going to happen unless we change the skill set of the American labor force.
Yeah, let me add something to that. If you look at the data on wage rates and incomes in the 20th century, for roughly the first 80 years of that time, income differentials were narrowing. We've been in a period now of about 30 years where income differentials have been widening, where the gap between the upper income groups and the lower income groups has been growing. The question is, why? And there's been some very interesting work done by this, and there's a book by Claudia Golden at Harvard, The Race Between Education and Technology. It says we just haven't provided the appropriate educational levels. And I'd encourage you to take a look at that book. But there are other things too. Let's look at unemployment compensation. Bob Barrow at Harvard had a very interesting piece about a year ago in the Wall Street Journal, and when he tried to calculate the impact of the 99 weeks of unemployment benefits in terms of the unemployment rate. And he concluded that it added, as I recall, about 1.5 points to the unemployment rate. I would take his numbers with a grain of salt, but the point is, at a time when we want people to go to work, aren't we better giving, as Professor Aliber suggests, incentives to firms to hire people rather than incentives to people to stay out of the labor force?
There's one big part of the economy that nobody's mentioned, and that's internet and intellectual property, both as a domestic factor and the international aspects. I don't know how to phrase a question about it, but perhaps you have some thoughts on this part of the economy.
Maybe is the question around the growing proportion of internet commerce, the growing proportion of, or the concerns about intellectual property being eroded? I wonder if...
Yeah, I mean, we're valuing on the stock market ideas much more than manufacturing assets.
Mm-hmm. I mean, as a longer run phenomenon, the value of what we would call intangible capital has been rising. Mm-hmm. So the value of intellectual property, the importance of intellectual property and income growth is expanding. And I think that's actually one of the underlying reasons why we see an income distribution that favors the topmost percentage more heavily, is because that intangible capital is much more consolidated than other forms of capital in our society. So I think it's an interesting issue. It's one that we have to watch. I mean, fundamentally, our current environment favors more intangible capital. We've been seeing intangible capital growing and growing in importance.
But this speaks to the issue in which we have, I'll use the term loosely, a monopoly advantage. It is much harder for firms in foreign countries to compete in this market than it is in the markets for steel and automobiles and traditional manufacturing products. So we would always tend to see the income on the growth for those involved in the growth frontier increasing relative to the incomes of those who are producing commodity-type goods. Nevertheless, if we get the trade issues right, then we will see an increase in incomes in manufacturing, and that's bound to occur because our trade deficit is too large to be sustainable.
Professor Upton?
Two points. First of all, this represents a lot of our concerns with China right now. There have been real issues with people outside the U.S. respecting intellectual capital created in this country, an industry which we're very good at. But second, it also explains some of the growing dispersion of incomes. I saw something, I think in yesterday's Wall Street Journal, that Chairman Bernanke, who's a superb economist, is going to videotape 4 lectures on monetary policy at George Washington University. A whole generation of future macroeconomists can just retire right now. They don't have to go into class. They can just say, watch the tapes. And, but it's true in other industries. Vaudeville died because television allowed for just a couple of first-class entertainers to entertain us all in our homes in the evening. So there are these pressures. They've created the unequal dispersion of incomes. But at the same time, they do create this enormous incentive for the U.S. because we do seem to be very good at creating intellectual capital. You look at computers, for example. Software gets written in this country. The computer chips get made in different countries in Asia.
This being a political year and an election year, what effect does that have on your what appears to be somewhat optimistic viewpoint? And are we ready for a letdown after January 1st, 2013? And secondly, with Congress at loggerheads with the president, what, if anything, can you expect from a policy standpoint in this year? This year is all we can talk about, because next year we don't know what's going to be like.
Well, I have a flip answer, and that is we have so much free political theater, people aren't going out to the movies and to other sporting events. And so when the election is over, then there'll be more spending.
Well, two things. First of all, I will give a forecast. In January 2013, we'll start worrying about the 2014 elections. Look, this year we've had 2 major groups that tried to get together and wrestle with how to solve the problem of the deficit. Neither group was able to come to a conclusion. I have enough trouble doing economics without trying to do politics, but somehow our political system is not able to achieve a solution to these problems. And I frankly suspect that we will be worrying about the 2014 election rather than worrying about getting solutions to these problems, no matter who wins the election in November.
Political uncertainty is not very helpful. I had a recent paper looking at sort of how much political uncertainty affects small businesses' desire to add employment. It's never helpful. The interesting thing is political uncertainty has actually been coming down relative to last year. So last year and the budget impasse and some of those issues, we had a real spike in political uncertainty. It's actually been coming down a little bit.
Okay. Well, thank you, panelists, and thank you, obviously, for the great questions. I think that was a very good way to cap our agenda today. So this does conclude our event. I just want to say thank you again to our 3 economists for participating in the panel, and thank you as well for your questions. Okay.